big story of the day. Credit rating agency Fitch has downgraded the credit rating of the U.S. government from AAA to AA+. It comes as a big shock to the Biden administration, and the White House is already playing the blame game when it comes to who's behind the downgrade. Jim Spellman starts us off.
Fitch has downgraded the long-term U.S. credit rating from its highest rating, AAA, to its next highest, AA+. This is only the second time a major credit agency has downgraded the United States.
Fitch says it anticipates, quote, expected fiscal deterioration over the next 3 years and cites the growing burden of U.S. government debt and deficits. Additionally, the rating house notes a, quote, steady deterioration in standards of governance over the last 20 years, cites the lack of medium-term fiscal framework while noting the complex U.S. budgeting process that often pits the White House, Senate, and House of Representatives against each other. Last month, Fitch warned that the frequently recurring challenges over raising the U.S. debt ceiling had put the AAA rating in jeopardy. The downgrade comes as President Biden has been touting the U.S. economy on the campaign trail.
I came to office determined to move from a trickle-down economics that everyone from the Financial Times and the Wall Street Journal and it's called Bidenomics, with a plan that's working, building from the bottom up, the middle out.
The White House rejects the Fitch downgrade, issuing a statement saying in part, "We strongly disagree with this decision. The ratings model used by Fitch declined under President Trump and then improved under President Biden, and it defies reality to downgrade the United States at a moment when President Biden has delivered the strongest recovery of any major economy in the world."
The Fitch report says the AAA rating could be restored if the White House and Congress come up with a better system for funding mandatory spending items. But it's hard to see that happening anytime soon in politically divided Washington. Jim Spellman, CGTN, Washington.
U.S. employers also added 324,000 new jobs in July. That was well above expectations. Payroll processing firm ADP reports that nearly two-thirds of those jobs came from leisure and hospitality, as the economy is doing better than expected. All this despite months of rate hikes by the Fed to try to slow the economy down and bring inflation down. The ADP report also shows that wages went up over 6% from a year ago, still high, but the lowest wage growth in nearly 20 months. We have more on that Fitch downgrade in just a minute, but first we're going to check in on how markets responded to that big news. Here's Karina Mitchell from New York.
It was a really somber day here on Wall Street tied to that downgrade from Fitch, and I'll have more U.S. market reaction in just a moment. But earnings season continues to roll on. More than half of S&P 500 companies have reported, the majority of those delivering a beat. Start off by talking about Starbucks. It delivered a record quarter for revenue, $9.2 billion, in large tied to a resurgence in China sales. Same-store sales in that region jumped by 46%, wiping out a decline last year tied to COVID. Now, the CEO was recently in China. He said there are 20 million active Starbucks Rewards memberships. He also said the average Chinese consumer drinks just 12 cups of coffee a year. Compare that to 380 in the U.S. So he said there is a lot of room for growth in that region. Revenue was also a beat. He did say North American sales did see some slowdown. On to CVS now. It reported a beat on both the top and bottom lines, but it does come at a price. The company now says that it needs to introduce some cost-cutting measures, which could include laying off up to 5,000 of its workers. That is tied to a big purchase. It made two of them, in fact, Signify Health and Oak Street Health. The total price tag for those companies about $19 billion. We're trying to rein in some of those costs. And then a look ahead to the Thursday session. Apple set to report, most valuable company. A lot of people interested to see how it performs. It is expected to deliver a third straight quarter of revenue decline. That is tied in part to worries over its hardware sales. Many people think that less people are interested in buying those iPhones and computers and iPads. Investors will also be very interested in its business services sector because that's a big moneymaker for Apple now. We're talking about Apple Pay, its Apple Music subscription as well. Fees tied to the App Store, so they want to see how that's performing. And then look at emerging markets as well. India has been an area that Tim Cook says he wants to expand in. And then China, Hong Kong, Taiwan together make up the third largest sales region. They've seen some declines. Investors are hoping for a turnaround there. Quick look at how U.S. markets fared. As I said, it was a risk-off session globally as stocks fell. The Dow accelerating into the close. The losses that they saw tied to that downgrade off by nearly 1%. The Nasdaq was the biggest loser, off by more than 2%, and the S&P down by more than 1%. Quick look ahead to Thursday. As I said, Apple set to report in the U.S. Amazon also set to report. Investors there looking at how its cloud service business fares. Karina Mitchell, CGTN, New York.
For more insight on this state of the economy and the Fitch downgrade, John Canavan, he's the lead analyst at Oxford Economics. Good to have you. You know, the White House responded to this downgrade basically saying that this was sort of an outdated report. We saw Jamie Dimon come out and say earlier on television that this was, you know, ridiculous, essentially. How should we react to this credit downgrade?
I don't think from a market perspective, much reaction is really required. The downgrade didn't really tell us anything we didn't already know. The concerns that Fitch cited are certainly legitimate concerns: the size of the U.S. debt, the growing nature of that debt, the political difficulties in the U.S. These are ongoing and long-term problems, but for the near term, they really don't tell us, as I said, anything we didn't already know. And the markets really had no reason to significantly react to this, and in effect, they did not. So it really made sense.
For more context on this, you know, we just went through sort of a bump up in the debt ceiling, and in a couple months, you know, the White House and Congress kind of have to do this all over again to get the next round sort of going. A lot of people are questioning the timing of this. Why do it now, a couple months out of these big negotiations? Is it really just a warning sign, if you will, to get both sides to come together?
That's a very good question, and that may be the case. There's certainly a big difference between the debt ceiling issue and the government funding issue. So as you noted, the debt ceiling has been suspended. That will take us through into 2025. What we're coming up with next is the government funding bills that need to be passed, but they don't. Those don't offer any type of a threat to the sustainability of U.S. debt. They don't offer any kind of a threat to payment of U.S. debt. So it's sort of a different issue. As for why why Fitch chose now, you know, you mentioned one factor, which is that perhaps they're trying to get ahead of the negotiations and to make clear the concerns that many have ahead of those negotiations. There's also some possibility that they were trying to get ahead of the Treasury auctions next week. So the Treasury this morning announced the latest outlook for Treasury supply, and they announced significant increases in Treasury issuance over the next few months and likely beyond that. And those increased auction sizes will begin with next week's 3-year, 10-year, and 30-year auctions. And perhaps Fitch just wanted to not wait until after those auctions. They didn't want to be accused of waiting beyond those auctions in an attempt to
but look, going back to the timing, you know, the disaster that we went through in raising the debt ceiling was quite a while ago. If you wanted to raise the warning and say, well, we have a dysfunctional government, both sides can't agree, we seem to not agree on whether the moon is even circle or square, why not do it then? Why wait till now? I mean, there's nothing happening right now.
I think that's a great question, and that's certainly a complaint a lot of people had when Fitch made their announcement. Perhaps, and I'm just speculating here, part of it was, again, those negotiations for the debt ceiling, and given just how contentious they were, that may have spurred Fitch to make these decisions. But the decisions do not come immediately. There's a lot of research that needs to go into it, but it is possible that the debt ceiling negotiations and the problems that we saw there were the tipping point that caused them to decide that this is what we need to announce, and then they just needed to cross their T's and dot their I's before they could make the announcement.
John, for the average American, and I think you might be a few years younger than I am, but we've been told about this loan debt crisis since probably we were in college. And every year they say the same thing. This loan, it's going to disable the next generation. And here we are. We've got an untold number of trillions in debt, which, by the way, we are paying for it. We have not defaulted on a single penny of it. But at the same time, for the average American, why should they even care about this downgrade? We already had another S&P downgrade, I think about 10 years ago. Why should they care at all about this one?
Yeah, in 2011, I don't think the average American really should care about the Fitch downgrade. As you noted, we continue to pay our bills. We are going to continue to do so as long as the dollar remains the reserve currency and treasuries remain the deepest, most liquid asset out there on the planet. There will continue to be strong demand for government debt. The U.S. is wealthy enough to continue to pay that government debt back for an extended period of time. So for the average person, the Fitch downgrade doesn't mean much. I think, however, it does highlight some of the longer-term generational issues that for politicians in particular, they should be paying attention. It is time now.
Well, let's do that. You said pay attention.
Yeah.
What should they do? Do they need to come together and go, we're going to have a balanced budget, which I don't even remember the last time we had that happen, that we actually stuck to it, but it makes no sense. Many countries around the world are required to have a balanced budget. We're one of the few that we almost celebrate the fact that we keep raising the debt ceiling. I understand why we do it, but how come there isn't the political will to get the two sides, or at least the White House or Congress or somebody, to say, look, if you're worried about the long term, stop talking about it and do something about it?
Yeah, I think what we need is incremental adjustments. We don't need a balanced budget amendment. We don't need a balanced budget immediately. What we need is stronger economic growth combined with some acknowledgement that continued growth in the debt relative to GDP is unsustainable. So I think that to a large degree what we need is perhaps a slower growth in spending, not an end to the rise in spending, and politicians doing everything they can within that context to increase economic growth, and we can in fact grow our way through the debt issue.
Right, John. You bring up a good point. Being fiscally responsible should not be a political thing. John, appreciate your time on this and your analysis. Thank you.